Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidated statement of cash flows. We're going to be using the direct method, and we'll also have a gain on sale of equipment. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you're following along in OneNote, if you have access to OneNote, and you don't need to because this will be in a presentation format, but if you have access and would like to follow along, we're going to be in section 1033. That's going to be under section Problem Presentations. We're going to go through the information first related to the problem, all the information, then we'll take pieces of that information as is needed as we work through our practice problem, as we put together our statement of cash flows. So we have S Corporation was created January 1st, 2000 X0, January 1st, 2000 X4, sold a percent to P at book value 80%. So in essence, we have P having 80% now, the parent, and S at the 20%. Fair value of the non-controlling interest in S is going to be the 20%. We're going to have the statement of cash flows using the direct method. The dividends that are going out from S, the subsidiary, will be the 17,000. The dividends for P will be the 58,000. Statement of cash flows using the direct method will be our objective. Here's going to have our information for the trial balances for the end of the prior year or the beginning of the current year that we're going to be doing our statement of cash flows for, and then the current year. So in the prior year, I would set them up in this way as we've done in other or prior practice problems, and that's going to be basically taking the balance sheet and or taking the trial balance and putting it back into basically a debit and credit format. We're looking at the prior year or January of the current year, or in other words, post-closing trial balance, a trial balance after the balance sheet accounts or the temporary accounts have been closed out to the balance sheet account. So for example, the prior year trial balance doesn't have anything below. The equity section, no revenue and expenses, those have been closed out to retained earnings and non-controlling interest. On the second side of things, these are consolidated worksheets too. So these are coming from the consolidated financial statements. And then we have the end of the year consolidated financial statements, which do include the temporary accounts. So now we have the temporary accounts down below. Our first step, unlike a consolidation, because these are already consolidated, we're not adding these up, but instead taking the difference between these time periods. So for example, cash, we started at 50,000 and then we ended at 79. So 79 minus 50 is a 29,000 difference, 29,000 increase. Accounts receivable ended 134,000 minus the starting point 152,000. That's going to be a decrease of 18,000, and so on and so forth. If we go to a credit balance account, such as accounts payable, we have the 92,000 ending point here. The 91,000, that's going to be a increase reflected by a credit in our worksheet here of the 1,000. If we go down to the equity section, note the equity section in the prior year, we only have the equity components and not the income statement components because they've been closed out into the equity section. And then in the end of the year, we do have the income statement amounts. Therefore, all of these changes all the way down will basically be the change in equity. Okay, so we're going to be doing our statement of the cash flows. It's going to look something like this. This is just be our worksheet before we populate it. We got the cash flows from operating activities that we will be populating using the direct method. And then we got the cash flows from the investing activities, cash flows from the financing activities. Let's go ahead and populate this or start to do so, starting with the cash flows from the operating activities. This, of course, being the component that will be different from the direct method and the indirect method. So we're using the direct method here. So we want cash received from customers. Now remember, the difference between the two here is basically going to be, we're going to get to the same result if we use the direct method or the indirect method. The direct method, you can think of it kind of like taking the income statement and saying, hey, look, I'm going to break down this line item by line item in a similar format to line item by line item, but taking the accrual numbers here and transforming them to a cash basis number. I think the direct method is easier to look at. It's easier to tell to someone else what it is, but it doesn't provide that reconciliation from the net income to the statement of cash flows or the cash flows from operating activities. Okay, so then if we're going to take that number, we could say, okay, how are we going to get to that number? We're going to pull up to a little worksheet down below. Say that revenue is going to be that 1,080,000. So that's going to be included in our calculation. And then the accounts receivable is going to be the accrual account related to that revenue. So we'll take that into consideration. That'll give us the cash received from customers. Again, I'm not going to spend a whole lot of time on, why we're adding or not subtracting. We could spend a lot of time thinking about this and actually how this puts together, and it's a good practice to do so. If you want to look into that more, you can get into our course on the on cash flow statements here. But we're going to say that that's going to be the 1,098,000. So there's the 1,098,000. Then we're going to say cash paid to suppliers. I'm going to do a similar little worksheet down below where we're going to take into consideration the cost of goods sold, the 735,000. And we will take into consideration the miscellaneous expenses, the 138,000. Then the inventory up top on the balance sheet. So we have the inventory, change in the inventory, and we've got the accounts payable. The accounts payable up top, change in the accounts payable, the 1,000. That providing us with, if we add those up, the 1,046,600. That 1,046,600 then being our component up top. This is going to be cash going out, so we're going to have a negative here. Adding those up, that gives us the net cash provided by operating activities at the 51,400. Scrolling back down, now we've got the cash flows from the operating activities, which we have calculated to be the 51,400. Let's move on down to the cash flows from investing activities now. So cash flows from investing activities includes a sale of machinery. So we have this sale that took place, and so we see that because obviously the ending machinery is the 657, beginning is the 807. Therefore, we have a decline of 150,000, which means we must have disposed of or sold machinery in some way. Now, when that's the case, then we're going to have to dig down. In practice, we would probably want to go into the general ledger, dig down on what that transaction was. There shouldn't be a whole lot of transactions that deal with that change because unlike other accounts, unlike, say, cash or accounts receivable, there's not a whole lot of times transactions that will usually be, disposals of equipment. But you might have a few purchases and disposals and whatnot that you're going to have to go in and consider for that. So here we'll kind of do a little bit of guesswork to figure this thing out. We're going to say, all right, well, we know the machinery went off the books. I'm going to think back to the journal entry. Again, in practice, I could go dig out the journal entry and find it in the, and then work from there. But if we just have this and we're going to say, well, let's kind of see if we could back into what happened on the journal entry. We could say, well, the machinery went down, the depreciable asset went down by the 150, and then we've got the accumulated, and I'm going to look at cash last, so that's why I didn't start with cash. The accumulated depreciation is going to be 100,000. I'll get to exactly why that is in a second, more detail, and then I know the gain is going to be the gain that was shown here at the 30,000. So that was a credit for 30,000. So I know what this number is. I know what this number is. Now I'm going to kind of figure out what this number is with another worksheet, and then this will be the plug. That'll then lead us to the plug, which will be the cash. So now let's think about this in terms of like a T account down below. We're going to say that the accumulated depreciation account started with the 278,000. There's the 278,000 up top. And then we had the depreciation expense of the 40,000. So here's the 40,000. So that would be a debit to depreciation expense and a credit here to accumulated depreciation. So accumulated depreciation would have gone up from this point by the 40,000. And then we know that it ended at the 218,000. We know that it ended here at the 218. So then the plug that we would need is the 100,000. The 100,000 must be the debit that happened with relation to the sale of the equipment, because that's what we need to get to that 218,000. So now we have the machinery declined by 150,000. There must have been 100,000 related to that in accumulated depreciation. We know the gain because we already see that on the books. We're assuming this gain is from this one sale. Therefore, the difference, if we back into it, the plug, what we need for this to be in balance, will be the cash of the 80,000. So there we have the cash of the 80,000. Now, again, note that these transactions can be a little complex to figure out, especially if you have more than one. So, like I said, if you may want to actually kind of reconcile this whole thing, and then go back and go back into the more complex transactions and figure them out at a later time once you've basically reconciled the whole thing. But I won't get into more of that in too much detail. But in any case, then we have the purchase of land. Land, we see that it went up, so we're going to assume there was a purchase. We assume the purchase took place with cash. Again, it could be more complex than that, but we're going to assume cash here. And then we got and how would it be more complex, or how would we know? We would then go into the general ledger, look at the transaction, see what happened, see if it was just cash that was paid or if there was something else going on. And then we have the net cash used in the investing, the 80,000 minus the 5, giving us the 75,000. Okay, so now we've got the cash flows from the operating, the cash flows from the investing done. Let's take a look at the cash flows from the financing activities. We have the bond retirement, and we know that because the beginning bonds were 259. We ended at the 223. That means they decreased by 36,000, which we would assume that means it retired the bond, and we had to pay out the bond at the maturity, at the retirement. So 36,000 would be money going out. Then the dividends to the P shareholders was 58,000, which we could see here as the difference in the retained earnings, because that dividends is included in the retained earnings. If we wanted to check that, we could check the GL and see what that 58,000 is, and we should be able to see its dividends. We could see it down here in our data as well. And then we have the dividends to the non-controlling shareholders, which is kind of the new thing we have to kind of deal with here with our consolidations, and that's going to be the 17,000 times, and I can't remember what the percents were, 20%, I think. 20% times 20. So I'm scrolling like crazy, sorry about that. Times 20.2. And that's going to be the 3,400, so there's the 3,400. So then if we were to add these up, then we're going to get the 97,400. That's the net cash used in financing activities. If we add up the operating activities, the investing activities, the financing activities, or the 51.4, the 75,000 minus the 97.4, we're going to get the 29,000. That's going to be the net increase in cash, and that of course will match out to our difference in cash up top. And then we're going to be looking at the cash at the beginning of the year, 50,000. We're pulling that from this number, the beginning cash, and that will of course bring us to the cash at the year end, the 79,000, matching the 79,000 on the trial balance and balance sheet in current year. So quick scroll through on the last thing. Here it is. Very nice. Quick scroll through. Very nice.